another phenomenon has been through this sort of funding winter in private markets is that any sort of exit timeline, well, you know what? It's going to take a little bit longer than I think most investors would originally have preferred, right? Yes. Does that mean if you're investing up and down the spectrum of the 10-year line that you're preferring businesses that are closer to exit?
Not necessarily, because it depends on where we are in the spectrum and which funds we're investing from it. So our early stage funds will continue to invest in early stage companies and, et cetera, et cetera. That's really how we invest into the opportunities in the market. Okay. The way that we see it is that over the last couple of decades in general, private companies have stayed private for longer. And that trend seems to be continuing on. So what does it mean for VCs like us? What it means for VCs like us is that...
You got to wait longer for your money.
Number one, we've got to wait. Yeah. We've got to wait longer for our money. Like we're going to have to wait longer to buy that donut, buy that big meal. Yeah. But what it also means, Martin, is that we have to learn new tactics and techniques to translate unrealized returns into realized returns. So we're seeing, for example, a much higher pickup in secondaries and secondary sales, especially for early stage investors, right, who have multiple avenues to exit companies along the path. But for the larger part in general, we are long-term investors with a long-term perspective. And our LPs or investors that invest, into VC as an asset class in general understand that this is not a get-rich-quick game. It's a get-rich-slow game.
Right, okay. Indeed. So when you compare it to maybe 2-3 years ago, one criticism they had of many of the boom, at least, if I may call it that, in terms of investments for a lot of these startups was because money was so easy to get, rates were so low, anybody who had an idea could actually float that and keep that company going. Now you're seeing that the bar for performance has been raised. Do you think that this in turn has, has this really led to perhaps VCs like yourself perhaps being a bit more selective this year in terms of investing? And what exactly is the metric now? What is the bar for profitability for a lot of these companies in terms of whether or not you want to invest in them?
So it's an excellent question, and I'm going to use an analogy just to explain what's happening right now and why we see a little bit of a pullback. So imagine you're a crypto investor, right? Put yourself 10 years back when people are early in Bitcoin and they've been studying the space and they know it and they're very, very specialized in investing in this asset class. Over the years, as that price increases and as there's more demand, it starts from crypto investors to investors in the financial ecosystem to retail investors, and before you know it, your mom, grandma, taxi drivers are telling you what cryptocurrencies are part of their portfolio. No one's making money at that time. And then when the prices start to fall and there's a pullback and the rug gets pulled under people, prices start to deflate. The professionals are still in the game and they're still investing in the asset class because they are there for the long term and they understand what they're underwriting. The same thing is happening in venture, just like it's happened in so many other asset classes, which is a lot of the tourist investors that came in because of inflated asset prices and thinking that it's just going to go up and the party is never going to end, have now left the arena. And so it leaves a few of us professionals in that are still investing quite actively in companies that are in market. Now, how has entrepreneurship changed? It's changed in a couple of ways. The first is, let's say you're in a more capital-constrained environment. The way you build the companies and the way you spend money changes fundamentally. So entrepreneurs are raising for much longer fundraise. They're being a lot more circumspect about how they spend money and are optimizing for product and growth, right? For sales-led organizations, you're not buying flashy offices. You're not spending money on things that are flippant. And VCs are working with companies very, very closely in understanding how to optimize the cash that they have to make it last as long as it can.